Welcome everybody to Volatility Trading Strategies. So we're in the heart of a pretty major event here in early 2020. We've just witnessed the largest VIX index spike since the financial crisis all the way back in 2008. Now, it didn't register as the largest single-day spike. This here is a list of the top 25 of those since 1990, and you can see the top billing here goes to the Volapocalypse event on February 5th, 2018. 115.6% in a single day, that was something. You can see, though, marked in blue there, the VIX spikes we've seen the past couple weeks rank number 7 and number 13 on that all-time list. Definitely significant. But this is where it gets interesting because this is a 10-year chart of the VIX. And you can see the intraday high touched 62.12. That is the highest we've seen since 2008. Higher than the flash crash in 2010, the European debt crisis in 2011, that 6-month-long S&P 500 crash in 2015, Volapocalypse in 2018, this reading of 62.12 tops them all. So there's definitely going to be a lot of people out there thinking to themselves, now is the time to short volatility, right? So right off the bat here, full disclosure, I am not short volatility right here. In my opinion, we're a long ways away from getting the green light for that. I've been in cash for the last couple of weeks just watching this all unfold. But on the other hand, other traders out there may have their own style. So if they know the risks and somebody did want to try to get bullish this market right now, just after a major crash, today's video is going to show that doing it through the various volatility ETPs is not an efficient way to go about it. So subscribe to the channel, smash the like button for me, and let me show you why. So in order to show why shorting volatility ETPs is not an efficient trade right now, we do need to spend a minute and go over how these ETPs actually work. The leveraged products like UVXY and TVIX work the same way, but today we're just going to talk about the 1x long volatility ETP called VXX, everybody's favorite. Now, side note, I've got a lot of articles and videos on my website explaining this in far more detail. But very quickly today, VXX derives its price by holding a composition of the first and second month VIX futures contracts. That's these two right here. As we move forward in time, it's holding less of the front month M1 future and more of the back month M2 future. All of these futures are sliding up the curve, and at monthly expiration, the front month VIX future M1 will converge to the spot VIX and be the same value. Now, because M2 is currently below M1, and both of the futures are below the spot VIX index, that means as we move forward from day to day, these futures are being pulled upwards towards the spot VIX index. This condition where M2 is less than M1 is called backwardation, and it's really steep right now at minus 16.87%. And the condition where both futures are below the VIX index is called roll yield, and it's also very steep at minus 29%. These two conditions, all other things being equal, act as a tailwind for the VXX and may cause its price to go up. So in layman's terms, what this means is, VXX has a tailwind right now, and it wouldn't be an efficient way to short volatility. Now, I understand that volatility is sky high right now, and if and when the market does recover, VXX is likely to start going down again. That has been its default setting most of the time, aside from some violent spikes upward along the way. VXX launched in January 2009, and using simulated prices back to 2004, yeah, we can say most of the time it goes down. If the markets recover here, shorting it may actually make a profit. But successful long-term investing is about efficiency and finding the best risk-reward profiles. Shorting VXX when the VIX futures are in backwardation and there's terrible roll yield right now would not be an efficient way to short volatility. You'd be swimming against the current with that trade. So now I'm going to show you some data and perhaps a better way to take that contrarian opinion you may have about jumping back into the markets here. Again, full disclosure, I'm not going to get back into the market just yet. But to each their own, of course, so let's compare two methods. So what we've got here are the largest S&P 500 drawdowns since the financial crisis in 2008. There's 6 of them that were significant. This past week is number 7, but it hasn't settled yet, so we're going to look at the previous 6 largest drawdown periods. Let's do a simple comparison. Short volatility through shorting the VXX versus long equities through long UPRO, which is a 3x leveraged S&P 500 ETF. The reason for the 3x leveraged UPRO is that the beta of the VXX compared to the S&P 500 since January 2009 has been 3.14. Beta is a measure of how one product moves in relation to another. 3.14 means if the S&P 500 moves by 1%, the VXX on average will move 3.14%. So using the 3 times leveraged UPRO gets us very close to an apples-to-apples comparison. Short VXX versus long UPRO. So during the flash crash in 2010, the S&P 500 from peak to trough dropped 15.99%. If a trader did time the recovery and shorted the VXX at the bottom, over the next 10 trading days, they would have made an 11.54% return. Pretty solid for 10 days. But if they bought the 3 times leveraged UPRO, they would have made 14.89%. During the European debt crisis in 2011, if a trader called the bottom and shorted VXX, they would have made 21.43%. But you can see right next to it, going long UPRO would have made 29.6%. We can go through all 6 of the biggest drawdowns, and the end result is that UPRO made substantially more profit on average. 21.22% for UPRO versus 15.24% for short VXX. In relation to the short VXX trader, there was almost 40% more profit available had they used the 3 times long equities instead. The reason for this is simple. Like we went over, the VXX is in steep backwardation right now and has a significant roll yield tailwind. Equities don't have that handicap. Now on the flip side, if we were in contango and we had an advantageous roll yield, like we would see in calmer markets, then in that case, you would want to favor the volatility ETPs. Now, I've got a lot of videos you can check out talking about the dangers of shorting those directly, as well as all the additional hedging cost required. But in stable markets, you would be better off shorting the VIX futures rather than long equities. But right now, in steep backwardation, long equities is the stronger play. Now, I also calculated the 20-day return, and it does start to get a little closer. This is when the VIX futures term structure is likely normalizing. And here you can see while UPRO still did outperform, the relative outperformance in relation to the short VXX trader is only about 25% now. And the more time that passes, and the more the VIX futures move into contango, that's when VIX futures overtake equities as the smarter play. So if I haven't said it enough times in this video, I'm going to say it one more time. In my opinion, I don't think it's ever wise to short volatility when it's this elevated. I think it's better in the long run to just wait for confirmation of the signal, wait for a little bit of clarity, and then start looking for that profit. But the conclusion today is that if you really do want to play the contrarian and go bottom fishing, looking for that reversal, then you would be better off doing that with long equities. Why fight the VIX futures term structure when you don't have to, right? Always trade where you have an edge. So if you liked this video and you want to learn more about volatility trading, head on over to my website, claim your free trial, and see if the VTS community is right for your long-term investing goals. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.